Good morning, everybody, and welcome to our next webinar on financial reporting. Now, in this month's webinar, we're moving on to AASB or IFRS 16. Earlier in the year, we focused on AASB 15, revenue from contracts with customers, and we also looked at IFRS 9, financial instruments. Now, those two accounting standards became mandatory for years beginning on or after 1 January this year. And now we're moving on to the next big thing, and that is AASB 16 or IFRS 16, same thing. And this standard is becoming effective for years beginning on or after 1 January 2019. And it's amazing to say it is September, it is spring, it is all the grand finals are happening, whether it's domestically or the kids or the AFL. It's all happening in September, but also not many months left before we have to apply this new standard. So welcome to today's webinar, and we hope you find it informative and useful. I want to start with transitioning to the standard because one of the very first decisions you have to make is what transition method do you want to use? Because your transition method would in a very big way determine the information you need to gather, the time, the effort, the project plan. So welcome to the webinar and let's kick it off. So the outline of this webinar, I thought I'll start with what is the business problem around this standard? Why is everybody up in arms? Why are we reading about this in the AFR quite regularly? There was an article on the 5th of September around Meyer and Woolworths and what it would do to their balance sheet. So we'll look at what is the business problem. Then I'll look at the effective date, 1 January 2019, and a little bit of information around that. And then I want to go on to retrospective application options for lessees. Now, in this webinar, I'm focusing on lessees. There are application or transition methods for lessors, etc., and for sale and leaseback. But the most controversial one and the one that our clients want to hear about at the moment are actually the impact for lessees. We'll talk about some of the practical expedience. We'll look at definition of a lease. We'll look at an illustration and a comparison of these transition approaches. I'm also going to touch very briefly on peppercorn leases, and that's for the benefit of our not-for-profit entities. And I want to show them a very brief example. And then we're going to talk about next steps. And lastly, do you need assistance? But in next steps, I want to come back to what is the business problem. I've given you a lot of theory in between, but next steps, what do you have to do now? And that is based on numerous discussions that I've had and am still having with clients who are trying to implement AASB 16 at the moment. So that's the outline of the webinar. So what is the business problem? Now, this is a diagram that we've put together really for discussions with clients. Now, if you're a private sector entity, for private sector entities, the business problem is how do I preserve shareholder value? Because, IFRS 16 is creating winners and losers for organizations with multiple leases. And it really depends whether you're a winner or loser, depends on how effectively you control the risk at each point in this lease management life cycle. Now, there's significant downside of IFRS 16 and non-compliance with IFRS 16. So if you're a listed entity, the downside could be there's a hit on your share price. It's linked to continuous disclosure obligations that you have. And can you, after the implementation of IFRS 16, continue to declare dividends? So what does IFRS 16 do to your retained earnings? And what does it do to your net assets if we think around your dividend tests? If you're a private entity, Not listed, what does this do to your bank governance? And again, your ability to declare dividends, a big one. And if you're a government entity, what does IFRS 16 mean for your accountability? For the judicious use of public funds. Now, I speak to a lot of government departments and agencies, and they are, all really concerned about budgeting, forecasting, and what IFRS 16 does to future profits and forecasted profits, because they are measured against to what extent they meet the budgets and the forecast. Now, in that red block, we've kind of summarized it to say, it doesn't really matter what your entry point is and what your potential downside is. It's all about what does IFRS 16 do to your profit and liability reporting. And profit is profit in future. What does it do to that? And liability reporting, what does it do to liability reporting on the date of initial application, but also in future? So it's all about profit and liability. The green blocks are how at BDO we are working with clients to help and to address this red problem, the imminent problem. And I'll come back to how we help and how we can help towards the end of the webinar. Now, the other way, if you're a public sector entity or a not-for-profit entity, you might have said on my previous slide, Aletta, we don't worry about share price and all those things. But what they worry about within public sector is to maintain public support. So if we put up a budget, do we meet the budget? So in order to put up a budget going forward for the next 5 to 10 years, do we know what IFRS 16 is going to do to those budgeted numbers, to the profit, to the assets, liabilities? So it's a very similar problem, but a slightly different angle. Public sector entities are worried about maintaining a public support, whereas private sector entities are looking at preserving shareholder value. So that's the business problem, really in a nutshell. I thought I will refer you to some press. Now, in the AFR, on the 5th of September, very recently, there was an article and the headline was Myer Woolworths hardest hit by new lease accounting standard. I've put the link in there for you so you can click through to the actual article in the Australian Financial Review, and it's talking here about why are they hit, how many, why are they the hardest hit, what will it do? They said, it's actually have an impact of, I think, 2 to 3 billion on their liabilities, but you can go and read that article. It's fascinating stuff, and it was all around the liability. What's going to happen with the liability in the balance sheet. Another example, this is an older one, that was the 9th of July 2017. This was around Wesfarmers Woolworths, and especially focusing on retailers and what this new standard will do for retailers. So Wesfarmers Woolworths liabilities to double under lease accounting change. Really interesting at the moment. We're having a lot of conversations with retailers. We're having a lot of conversations with governments, government departments, government agencies, anybody who have a lot of leases and long-term leases. And long-term leases would be for longer than 12 months. And there's a lot of tricks here. And the standard is actually quite complicated on how do you determine whether you've got a lease, what about embedded leases, how do you determine the lease term, and if there's options to extend, when do you take those into account, etc. So it's not as straightforward. So I thought I'll start with that. That is what's getting people interested. Can I declare my dividend? How do I protect my shareholder value? How do I maintain public support for the government, after the standard has been implemented? And I've given you some references to 2 articles. So if we look at 1 January 2019, the clock is ticking down. The effective date of IFRS 16 and also AASB 16, and you'll see I use the terminology AASB 16 and IFRS 16 interchangeably because they're exactly the same. is for years beginning on or after 1 January 2019. Therefore, if you've got a 31 December year end, you'll have to apply and disclose and incorporate into your financial statements for the year ending 31 December 2019. If you've got a 30 June year end, we're talking about 30 June 2020. You could say, why we're looking at it now, so whether your date of initial application, so that's the beginning of the first financial year where it's mandatory to apply IFRS 16, whether it's the 1st of January 2019 or whether it's the 1st of July 2019, you are already today in September within the comparative year. So your current year financials will be 31 December 2019, your comparative year 31 December 2018, and we're already in that comparative year, and the same for June. I think the other thing that's really interesting is that AASB or IFRS 16 was issued in January 2016. So 3 years before it became mandatory effective. And there's a lot of talk, so why did they give us 3 years to get ready? Now, it could be because we were also getting ready for IFRS 9 and IFRS 15. But the other reason is, this standard is relatively complex. It's got a huge potential impact on your financial position, your balance sheet, your liabilities, on your financial performance, your profit and loss. It has a big impact, and it's very important when you look at your financial statements, your KPIs, and people who look at financial statements, the users, lenders, investors, regulators would be very interested in this. And then the last, I think, obvious reason is the cost of implementation and the impact on processes and systems are huge. The manpower required and the implementation around doing all the calculations are quite extensive. And later on, I'll come back to how BDO can help you around. We've got a technology solution that we're selling to you. You take control of the information. You take control of the information and you manage the information on an ongoing basis. So we've got a solution on how we can help you. If we look at the retrospective application options for lessees, and the focus, as I said today, is on lessees, because the biggest change is for lessees. So if you have to apply AASB 16 for the first time for years beginning on or after 1 January 2019, how are you going to do it? Now, it's a little bit confusing because the standard says there are two retrospective application options. Now, I want to put an emphasis on retrospective application options. It doesn't matter what you do. These options are looking at retrospective application. Disclosure might be full retrospective or modified retrospective, but your actual calculations, we're looking retrospectively. If you look at the full retrospective method, which is basically the full retrospective disclosure method, your comparatives will be restated. The cumulative effect would be recognized against opening retained earnings at the start of the earliest comparative period that you present. So let's say you've got a 31 December year end. You'll have 31 December 2019, your current year under the new standard. You'll restate your comparative year 31 December 2018, and everything before the 1st of January 2018 will be adjusted against retained earnings on the 1st of January 2018. If you use the full retrospective disclosure method, there's a third statement of financial position that will be presented at the start of the preceding or the comparative year. So in our example, a third balance sheet at 1 January 2018. And then also there's limited transitional relief. Now the transitional relief that we're talking about here is transitional relief in relation to calculations. and the extent to which you have to go back in the past. So if you do full retrospective disclosure method, you have limited relief around your calculations aspect. Full retrospective disclosure method will give you very nice comparable information, but it's very costly if you've got a lot of leases. Because there's not a lot of transitional relief available, it's a comprehensive calculation. So you have to weigh up whether comparable information and the benefit of comparable information outweigh the cost of putting that information together. Now, as I said, the other broad category that they've got here is the modified retrospective disclosure method. Now, in this one, the comparatives are not restated. So you're only fixing the current year, so 31 December 2019. You don't restate 31 December 2018 or any earlier years. Now, all the changes before the beginning of the current year, so everything before 1 January 2019, for example, will go against the opening retained earnings on the 1st of January 2019. There's no requirement to present a third balance sheet at the beginning. And then very important is the second last bullet point under modified retrospective method. And that says there are actually two approaches for calculating the ROU, which is right of use asset, on a lease by lease basis. So basically, the modified retrospective method splits into two alternatives. And therefore, if you think about what are my possible transitional approaches, there's actually three. And then if you use any of the modified retrospective methods, there's a lot of transitional calculation relief available. So if you look at the full retrospective approach, comparative figures are restated as if IFRS 16 had always been in effect. If you look at disclosure, the current year is according to IFRS 16, comparative year according to IFRS 16, and you restate retained earnings at the beginning of the comparative year. If you look at modified retrospective approach number one, because remember I said there's two of them. Under the first one, we've numbered it number one just for ease of reference. In this approach, the lease liability is the net present value of the remaining or the future lease payments, and you use the incremental borrowing rate at the date of initial application, for example, 1 January 2019. So you don't worry about the lease payments that were made in the past since inception of the lease. You're just saying, I'm standing here 1 January 2019. Let's work out my lease liability on the 1st of January 2019. And the way I'm going to do that, I'm going to say it's the net present value of my future lease payments using this incremental borrowing rate at the date of initial application. If you then go on and you look at the right of use asset, we'll say the right of use asset is recognized at the date of initial application, and that's a terrible typing mistake I've got there. The right of use asset is recognized at the date of initial application as an amount equal to the lease liability that we've just calculated, using the prevailing incremental borrowing rate at that date of initial application. So we're just going to say, I've calculated my lease liability, and that lease liability will now equal the right of use asset. But I'll adjust that right of use asset for any prepaid or accrued lease expenses that related to any leases that were recognized in the statement of financial position immediately before the date of initial application. So what am I saying there? If you currently have operating leases under the existing AASB 117, you would have worked out an even operating lease expense over the period of the lease. And in order to work it out and to make it happen, you would have booked an accrual or a prepayment, which you would have adjusted over the period of the operating lease. So what you're going to do here is you're going to say, what is my lease liability on the 1st of January 2019, just looking at the future. And then you're going to say my right of use asset is that lease liability plus or minus that old accrual in terms of AASB 117, because we have to get rid of it in some way. The other approach, and a modified retrospective approach number 2, the lease liability is calculated exactly the same way as we used for modified retrospective approach number 1. So we're looking at future lease payments. However, in the third bullet point, and this is what makes this approach really hard, is the right of use asset is recognized as at the date of initial application as if IFRS 16 had always been applied. But it's calculated as if the prevailing incremental borrowing rate as at the date of initial application is also applied at lease commencement. So you're not going back to lease inception on the 1st of January 1980 and use the incremental borrowing rate at that date. Because how do we know what that was? They're saying, no, you work out what is the right of use asset, and you use the incremental borrowing rate on the 1st of January 2019. So they're trying to make it a bit easier. Now, I have to tell you, the full retrospective approach and this modified retrospective approach number 2 requires a lot of data, requires a lot of information, requires a lot of calculations, and is complex. By far, the easiest method is to use modified retrospective approach number 1. So the benefit of this approach is the fact that it is only looking at the future. You don't have to scratch around for old information necessarily. You just look at what leases do I have in place now, what are the remaining payments, what are the option periods in future, and you don't have to reinvent the wheel. Obviously, there's another benefit to this approach. And the beauty of this approach is actually that on the date of initial application, there's no adjustment to retained earnings. Therefore, it could potentially help you with your ability to continue to declare dividends. The downside of it is it pushes your interest expense and your depreciation expense into the future. So you'll have to make sure that you can cover that, stomach that, and that it's acceptable. However, I'll look at all of these approaches in more detail. I'm going to do a worked example based on each of these so you can see for yourself the potential impact on the numbers, because that's when it comes to light, when you see the numbers. So if we look at the retrospective application options for lessees, I thought I'll put it slightly differently and say, yes, there's the full retrospective approach. There's the modified retrospective approach. And the modified retrospective approach actually have 2 alternatives within it. And it's all around the right of use asset. For both of them, the lease liability is determined the same way, looking at future payments, net present value of future payments, incremental borrowing rate on the date of initial application. But how you determine the right of use asset is different. And that is important to note. So my question to you is, have you decided on a transitional approach? Because you can already sense that depending on which transitional approach you select, you would need different levels of information and different types of information. So I think it's really important that if I'm speaking to preparers today, that you should consult with your financial statement users, and especially those charged with governance, the board or your audit committee, ASAP, to assist them in determining which approach to transition is most suitable to their needs. So, the numbers could be very big. And could be very different under the 3 approaches. So it's very important that the board and the audit committee make an informed decision on what approach they want to use. So what we're currently doing for a number of clients is we are capturing the data or getting the data from the client, and we're putting it into our technology solution, BDO Lead, and we're giving them numbers for each of the 3 transition approaches. And we're giving them numbers and journals on 1 January 2019, date of initial application. And we're also running reports and showing them what will the interest expense be over the next 10 years under each alternative, and what will depreciation over the next 10 years be under each alternative, so they can make an informed decision based on their actual numbers. Now, obviously, that's time consuming and costly, but if you've got a lot of leases, it's worth doing. And we've got the technology solution to do that. You have to think, what are the benefits of the different methods? So the big benefit of full retrospective method is the comparable information. And the benefits of the 2 modified retrospective approaches are slightly different. They are simpler due to the fact that there are more practical expedients around the calculations. But, the modified retrospective approach number 2 still requires a lot of data and calculations and effort, still has an impact on retained earnings. But it's important to think that through. Before we go much further, I think it's important to consider the definition of a lease, and particularly in the context of practical expedient number 1 around the definition of a lease. Now, we will do a number of webinars still where we talk about problem areas, and one of the problem areas is the identification of leases and embedded leases. But I think it's important to understand that this particular practical expedient is available for all transition methods. And this is actually the only one available for the full retrospective method. And it is that currently you would have applied AASB 117 or IAS 17 and interpretation 4 to decide whether your current contracts would be leases or contain leases or not. And now at the date of initial application, or that start of the current period of adoption, there's a new definition of leases. And what they're saying is, we're happy for you as a practical expedient to not reconsider whether a contract is a lease or not, but that you continue with your existing classification and determination. So that's a big one. The other practical expedients only apply to the modified retrospective approach. So it's important to know that these practical expedients, which you can select to use some and not others, will really help you on the calculation side. But modified retrospective usually only gives you disclosure relief, where the practical expedients give you the calculation relief. Now, I'm not going to overdo practical expedients, but just saying that practical expedients number 2, 3, 4, 5, 6, the 5 of them are available to modified retrospective approach. The second one, we've just numbered them for ease of use. The second one says you apply a single discount rate to a portfolio of leases when they've got reasonably similar characteristics. The third one, practical expedient 3, relates to onerous leases, and saying that you use your onerous lease assessment and any provisions that you've recognized in terms of AASB 137 before you apply IFRS 16, instead of doing an impairment test under IAS 36. So it makes that transition easier. And practical expedient number 4 is you exclude initial direct costs from the measurement of the right of use asset. So instead of going back and looking for all these initial direct costs, you just make a practical you use the practical expedient just to not go back in history and make it easier. Practical expedient number 5, there's no requirement to recognize leases when the lease term ends within 12 months of the date of initial application. And I think it's important there, however, to consider whether you've got options to extend, because as soon as you've got options to extend, it would have an impact on your leases and your lease term. And then number 6, you can use hindsight for example, to determine the lease term, if the contract contains options to extend or terminate the lease. So you can say on the 1st of July or 1st of January 2019, I know that I've extended certain contracts or that I've exercised certain options, and you take that into account. I think what is interesting is this next slide is these optional transitional reliefs on the calculation side that's available. As I said, there's 6 of them. If you look at the full retrospective method, only one calculation practically expedient is available. If you look at modified retrospective method 1, you can see 2 of them are not applicable, the other 4 are available. If you look at modified retrospective method 2, all of them are available. So you should consider this, because the more practical expedients you use, I would say the easier your calculation becomes. However, I have to say modified retrospective method number 1 really is an easy calculation. It depends on whether the number makes you happy as well. Now I want to look at an illustration and comparison of the 3 transition approaches with one simple example, just to illustrate what it could potentially do. So maybe you look at this and you say, based on what I've seen here, Aletta, I have enough information to decide on a transitional approach. What will be best for my organization? Or you could say, gee, the numbers could be really wild, really big. BDO, help us on your technology solution to run all the alternatives, and we can make an informed decision for our organization. So in my example, I've said entity A enters into a 10-year lease for a piece of equipment on 1 January 2017, and in the process incurs $500 of initial direct costs in the form of commissions, which were expensed under IAS 17. So under the existing standard, we would have expensed it. Now, entity A will pay the lessor $1,500 per annum on the 1st of January of each year. So that is the lease expense, the lease payment in advance. Now, the lease does not contain any termination, extension, or purchase options, luckily, because that's where it gets really complicated and tracking these are out of control. And then the rate implicit in the lease is 7%. So we know the rate implicit in the lease. They also tell us that entity A's incremental borrowing rate as at the 1st of January is 5%, because we need that incremental borrowing rate for the modified retrospective approaches. Now, the lease was previously classified as an operating lease under IAS 17, and we've made the following additional assumptions. So the contract meets the definition of a lease under both the existing IAS 17 and the new IFRS 16. The lease does not meet the low value or short-term lease exemptions under IFRS 16. Entity A has a calendar year end. So effective date or date of initial application is 1 January 2019. And remember, we entered into this lease 1 January 2017, 2 years ago, and it was for 10 years. And entity A will use the cost model to amortize the right of use asset. So cost model, you'll amortize the cost of that right of use asset over the expected useful life of the asset. And if the lease term is shortened, then the expected useful life, that shorter term. So question is, so how would we calculate with a full retrospective approach? And sorry, I just want to go back and put some information in here. We're talking about, in my calculations, it's 500,000 of initial direct costs, so $500,000, and the payments are $1.5 million per year. I've neglected to put that in. So, however, when we look at calculate the lease liability at 1 January 2016, so full retrospective approach, you have to go back to the date that you've entered into this lease, and you have to, step one, calculate the lease liability at 1 January 2016. And the way we do it is we would say we look at the fixed payments from commencement date, and if you work out the 9 remaining payments of 1.5 million discounted at the 7%, you get to the 9,773. You add to that the variable payments, and we've got nothing. Is there residual value? Nothing. Is there exercise price on purchase options? Nothing. Is there termination penalties? We say nothing. And in this situation, we therefore realize that our lease liability, or the net present value of future lease payment as at the 1st of January, was 9.773 million. Remember, we've got payments of 1.5 million. Then we say, okay, if we know the lease liability at the 1st of January 2016, what was the right of use asset at the 1st of January 2016? Now, the right of use asset, you start with the lease liability that you've just calculated, the 9.773 million, and you say my initial direct cost is the $500,000. My cost of removal and restoration at the end of the lease in this example is nothing. And you also add payments that will be made prior to commencement. So on day one, you have to make a payment on 1.5 million. Now that payment will not be included in your lease liability at that date because you've already paid it, but it has to be part of the right of use asset. So it's included here. We deduct potential lease incentives that we've received, which is nothing. So now you can see your right of use asset at the 1st of January 2016 is 11.773 million, which is more than liability on that date because the liability did not include the payment you made on day one. All right, so if we go on and we look at what would be the next step. Step one, calculate the liability on 1st January 2016. Step two, calculate the right of use asset at 1 January 2016. And then we have to do an amortization table for this lease liability. So for each and every lease, we need an amortization table. And here we're going to say, it means that our opening balance in 2016 was 9,773 on the liability side. We work out the interest based on our incremental, we work out the interest based on the 7%, which was the interest rate implied within the contract, which I've given you, and you work out the closing balance. So if that's the opening balance, if that is the interest that I've paid, that's my closing balance. For 2017, I now have an opening balance. I have a payment at that date. I have interest for that year, and I've got a closing balance. So my interest is opening balance less payment because it happens at that date, multiplied with 7%. And my closing balance is my opening balance less the payment plus my interest. And I work out an amortization table over the period of the lease. Now, I've done it up to the end of 2018 because we are going to implement this new standard on 1 January 2019. So I need the numbers at the end of December 2018 to do that transition. So that's step three. Step four is to work out the right of use asset at each date because we've entered into this contract on the 1st of January 2016, but what would the value of the asset be if I've adopted the standard now on 1 January 2019? Now here, expected useful life was 10 years and our lease term 10 years, so we've said opening balance amortization charge over 10 years. So we've kept it simple. So that's the summary of the information we've calculated. And this you have to do for each and every lease. So you would have said, okay, my right of use asset for this one lease at the end of 2018 was 8.2 million. At the end of 2017, 9.4. My lease liability 8.6 at the end of 2019, and my liability at the end of 2017 was 9.5. And then you can see the difference between the two, the extent to which my liability exceeds my asset at the end of 2018 is 408. So what we're doing here is, with a full retrospective approach, this is the information that I'll have to disclose in my financial statements. So my right of use asset in my comparative, at the end of my comparative year, will have to be this 8242. And my lease liability at the end of the comparative year will have to be the 8650. And I'll have to have this adjustment to equity at the end of the comparative year, or actually on 1 January 2019. So the journal that I've given you here is the journal according to the full retrospective approach, and the journal that I will process on the 1st of January 2019, the date of initial application. On that date, I'm going to say, I have no right of use asset in my books, and this is what the asset should be on the 1st of January 2019, 8242. My liability has to be 8650. And the difference between the two will have to be debit opening retained earnings of 408. So this is the journal on the 1st of January 2019. However, when you start to disclose it in your financial statements, you will disclose now for the current year, the depreciation for that year, and you'll disclose the interest expense for that year. And for the comparative year, you'll have the interest expense and you'll have the depreciation expense, and everything that happened before the comparative year, you will adjust against opening retained earnings on at the end of December 2017. So your adjustment against opening retained earnings, when you disclose it, only when you disclose it, is the 165. And that's why we've done that calculation. So there's a difference between the journal you process on the 1st of January 2019 and the disclosure in your financial statements at the end of December 2019. So that's one alternative, and I just want to show you, this is just one lease, but look at the impact on equity. If this was in millions, that would have been 408,000 reduction in equity as a result of one lease. So if we are looking at entities putting in a lot of liabilities, yes, they're also going to put in right of use assets, but the right of use asset will often be less than liability, and there will be a big downward adjustment to equity under the full retrospective approach. And the question is, if that wipes out your retained earnings at 1 July 2019, how are you going to declare dividends? So that's an important thing to think about. If we look at modified retrospective approach number 1, how would we do this? So this is the one that's the easiest, and there's another benefit that you'll see very soon. The first step is you calculate the lease liability at 1 January 2019. Remember, if we do the modified retrospective approach, we only do a forward-looking calculation of the lease liability. So we are saying it is, what are the remaining payments over the next how many years? So it's 7 years left, and it's payable in advance, and we discount it at the incremental borrowing rate at this date, which is 5%. There are no variable payments, residual values, etc. And you can see that my lease liability for the net present value of the remaining 7 payments are 9.114 million. So that's an easy calculation. It's just, what are the remaining lease payments? How do I calculate the right of use asset on 1 January 2019? We are merely saying the lease liability that we've calculated, we plus or minus the prepayment or the accrual. And in this example, we've made the assumption the accrual was 0, but even if there was a number that you're already calculating and putting in your financial statements, it would be the lease liability plus or minus that accrual or prepayment, and that will give you your right of use asset. Now, the beauty is in the next slide. can you see that your journal entry is debit right of use asset 9114, credit lease liability 9114, and there's no impact on retained earnings at the date of initial application? So I'll give you another example. You would say, Aletta, that's because there's no accrual. So let's look at a situation where there was an accrual of $1 million. If there was an accrual of $1 million, my right of use asset would have been 8114, and therefore my journal would have been debit right of use asset 8114, credit lease liability 9114, and I would have said debit lease liability, that accrual, debit the accrual that's already there of $1 million to get rid of it. So I start with a clean slate. And again, there's still no adjustment to opening retained earnings. So if you are concerned that you don't want to wipe out your retained earnings at the date of application of the new AASB 16, this is the approach. You have to be careful though. What does the next 10 years look like? You know, what would be the depreciation interest expense, because that could be potentially a bit inflated. Modified retrospective approach number 2, you have to calculate your lease liability at the 1st of January 2016. So here you have to go back into the past again. So it's not the nice shortcut. Now, I just want to say, why am I calculating this lease liability at 1 January 2016? I'm only doing this calculation in order to determine my right of use asset at that date. To process the journal, I actually only need the lease liability at the 1st of January 2019, similar to the previous approach. However, there's no way to determine the right of use asset on the 1st of January 2016 if you don't know what the lease liability was on the 1st of January 2016. So it's not much relief here. So you have to go back to my lease liability on the 1st of January 2016 when I entered into this lease. Important, this number, we're now looking at the incremental borrowing rate of 5% at the date of initial application 1 January 2019. When we did full retrospective method, we did a similar calculation, but we had to use the 7%, the incremental borrowing rate that was, or the implicit rate in the contract. So the rate is different, but the rest of the calculation is the same. So you come up with a lease liability. You would say that lease liability, I now make certain adjustments in order to get to my right of use asset on the 1st of January 2016. And now you're saying, okay, how do I work out calculate the right of use asset at 1 January 2019. Remember, when we did modified retrospective approach 1, we did the nice shortcut approach. However, when we do it now, we can't use that approach. We have to calculate the right of use asset by taking the right of use asset that we've determined, and we have to have an amortization charge over 10 years, and we have to work out our right of use asset is 8514 on the 1st of January 2019. So this slide is just showing you the contrast between the two. So the summary here is, if you look modified retrospective approach, there's a lot of calculations, and you end up with a right of use asset 8514. You end up with a lease liability, the 9114. Remember, the lease liability is a forward-looking calc, similar to what we did for modified retrospective approach number 2. So I just want to show you that. Remember this slide. This lease liability at 1 January 2019 is also the one we use here for this retrospective approach. We just do a different thing for the right of use asset. We did this whole long-winded calculation to come up with the right of use asset. And when we process that journal, look at the impact on opening retained earnings. It is actually huge. It's bigger than full retrospective approach for this particular example. So again, the numbers are quite revealing. So if we look at the comparison, it's only with the modified retrospective approach number 1 that there is no impact on equity, opening retained earnings, on the first time application of IFRS 16. It's the only one. The two versions of the modified retrospective approach can be adopted on a lease-by-lease basis. So you can do modified retrospective approach 1 for your high value leases and modified retrospective approach 2 for maybe lower value leases. And I think that's an important thing to remember. If we look at peppercorn leases, and this is just briefly for our not-for-profit clients so they don't think we've forgotten about them, there's an amendment to the new AASB 16 that says if you have a peppercorn lease and you're a lessee in a peppercorn lease where you pay $1 a year for 30 years, if you work out your lease liability, it is $1. And you're not going to say my right of use asset is the $1 or however way. They're specifically saying the right of use asset have to be measured at fair value. And the lease liability will be the present value of your future lease payment in future. And you will recognize the difference. Your right of use asset at fair value will be a lot more than the lease liability, the net present value of the $1 or the peppercorn. And therefore, that difference is often recognized in income on day one, potentially AASB 1058. And that is a big impact to be aware of. And for our not-for-profit clients, although they can use BDO Lead to do all their calculations, do you have experts to determine the right of use asset, the fair value of the right of use asset? And that is not the fair value of the asset. That is the fair value of the right to use that asset for a particular period of time. So in my example, for instance, I've said School A enters into a 30-year lease with a lessor for the use of a building. The lease contract specifies lease payments of $100 per annum. At inception of the lease, the fair value of the right to use the facility for 30 years is determined to be $360,000, and we got corporate finance to do that. The leased premises must be used for education purposes, so it's not sufficiently specific, so we can use AASB 15. No, we have to use AASB 1058 instead. There are no other conditions in the lease. And let's assume the net present value of the $100 that we have to pay every year for 30 years is $1,500. So your journal entry on initial recognition is you debit a right of use asset, the fair value of that right, $360,000. You credit a lease liability, the net present value of the 100 over 30 years, $1,500, and you've got a big income on day one. As a result of entering into a peppercorn lease. So this is just something to be aware of. Now I want to wrap it up with next steps, and I think this is important. I want to go back to private sector entities who want to preserve shareholder value and who are worried about profit and liability reporting. And I want to warn you that this is a painful process. The first thing genuinely is to decide on which transitional approach you want to use, or I want to do a comparison of the numbers to decide. And then if you look at all these green blocks, you go right to the right. It starts with, do you have the lease data? So we have to capture the basic lease data, which is a lot more comprehensive than the data you've currently captured to apply AASB 117. And then we have to do assessment of that data. So the quality of the data, what will you be extending options or not? Will you be using termination options or not? A lot of judgments will have to be made. And then BDO Lead is our technology solution that takes all the data, that takes all your assessments and judgments, which we can help you with. We put it into BDO Lead, and it houses all the lease data. So now you've got all your lease data in BDO Lead. We can do an import out of an Excel spreadsheet, and now you maintain your leases data in BDO Lead. So if there are reassessments, modifications, you capture it in BDO Lead, which also has an audit trail. And then once you've done all those calculations, that's where the IFRS advice comes in. So what can we do differently to protect our profit, to protect our liabilities, etc.? But it's a long journey. to get to that IFRS advice piece. And the same process really for public sector, not-for-profit entities. I think what is important, we have a technology solution. We have been inundated with requests for demonstrations and purchases of BDO Lead in Australia. It originates from Germany. We've decided to make this now a cloud solution and put the data in the data center in Australia in Canberra for security reasons, in order to facilitate, implementation across a large number of clients. But once you've got access to the cloud with your data there, we upload it out of Excel, you now are in control of your lease data, and you run the reports and you do the budgets and the projections, etc. And you can click there to see it on our website. On our website, there's an hour demonstration on how the tool actually works. But if you want to speak to me, please contact me and we can arrange for a demonstration. So that's the information that we've got on BDO Lead. The next steps, I would say, do you have copies of all your operating and finance leases, hire purchase agreements? Have you decided on a transitional approach? Do you have all the data necessary to implement IFRS 16? So I've got Excel spreadsheet of all the data that's required for each transitional approach. To give you an idea, the data that you have to capture. So it's columns and columns of data you have to capture for each lease. And if you can capture it in that Excel spreadsheet, we can upload it into BDO Lead, and then the reporting is very easy in running the reports. Do you have a technology solution? Because I suggest if you've got more than 20 leases, you need a technology solution. Can you maintain your leases on an ongoing basis? So you don't want to provide this lease information to somebody, they do a calc, and now you have a calc at a date. You want to be able to maintain your leases because you're going to change your views on whether you want to extend an option or not. Do you have that ability? So still next steps. Have you educated yourself and your team on the requirements? Have you done a risk assessment? What will it do to your profit and balance sheet, your liabilities? Have you decided on a response? Do you have a project plan? Have you decided on a transitional approach? And have you thought about processes and systems? So if you need assistance, we have a number of things available. So you can register for our webinars. Now, the upcoming webinars in October and December, we're going to look at an IFRS 16 risk assessment, and we're going to look at IFRS 16 problem areas. So this is based on our experiences with our clients to date. There are also previously recorded IFRS 16 webinars, 3 of them from last year. The first one in February was just an overview of the impact, and then in September and October, we actually looked at some of the detailed requirements on identifying leases, determining the lease term, etc. So you can look at those recordings, you can download the slides. We also have newsletters, and if you register for our newsletters, each and every month there's an article on IFRS 15, IFRS 16, and practical examples, things we encounter, trying to help people. We also, if you click on the bottom link and you look at our IFRS technical resources, there's one publication that is genuinely highly recommended. And that is the one on IFRS in practice. If you click on IFRS in practice and you look at the leases one, it was updated in February of this year. And that IFRS in practice in section 10 has a whole section on the transitional approaches. That's what it looks like. And in section 10, which is, I can't see the page number here, there's a number of examples, so you can make a decision around what transitional method you want to use. So all of that available to you. The other way to stay connected is linked with BDO Australia, link with me personally on LinkedIn. I publish newsletters, articles, etc. If you're looking for technical advice, I'm looking after Melbourne and National. Kevin works with me in Sydney. Wayne in Perth, and Clark in Brisbane, and you can click on that link to get contact details. Now, in this team, we've got 2 new additions in Melbourne. I haven't put their photos in yet, but Cameron and Samantha has joined us in Melbourne. They've started on the 3rd of September, and they're working with me within IFRS advisory, and I would say quite exclusively on the implementation of IFRS 16 and BDO lead. Any questions, please pop it in the question box. Please send me a text message or an email. Please contact me. I would love to speak to you. But thank you very much for joining me today for this webinar. It was a fast 1 hour on transitional methods, a few high-level tips. And I hope you join me again next month, where we look at more of the details and a risk assessment around IFRS 16. Thank you very much. Enjoy the rest of the day.